How you doing? Welcome to the show. We normally talk about gold, crypto, silver, especially silver. Silver is one of the things that are going to change drastically in the next few weeks, I believe. We're going to have to see. Could start as early as tomorrow. I'm not the only one talking about this, but we're going to talk about our financial system and could it collapse? And is it in our future, in our near future? Multiple people have come out and stated that we could be seeing a collapse as soon as the summer, maybe even sooner. Some are freaking out because the war has changed things. You're starting to see the Dow, the S&P, the NASDAQ, a lot of things happening. You're seeing a lot of countries that are having some issues with the United States. You're seeing a lot of countries that are with the United States, especially against Iraq. But I want to talk about our financial system. Could it collapse? There's a lot of information here today. And if you do like what you see and hear, please like, share, and subscribe. Don't forget to hit the bell for all so you can get all of the notifications for every time I have a show. And I try to do at least a few a week. Now, we've all been through multiple, at least a couple of financial collapses over the last 40, 50 years, if you're as old as I am. Here's what most people miss. Now, the first collapse, I think I was in my my teens, just like maybe a lot of you. I didn't even know what was going on. I'm sure my parents didn't know either. So the first was around the 1980s. So there was over 1,000 banks that collapsed. Nothing had prepared me in life to see any red flags. Nothing at all. There was a huge crash going on the equated to about $500 million in today's value. Over 1,000 savings and loans. Now, which was a name for a bank back then. 1,000 of these banks. Actually, they all went out of business during this period. So, crash number one was going on. I was still in high school, but I didn't have any idea what to look at. We didn't have internet. You had a newspaper, but it was a lot like today. They spread propaganda that works for whatever political Democrat or Republican that was in office, whatever worked for them. Sometimes it didn't go their way, but someone might step up. One of the mainstream media news reports might show something, but most likely it was what they wanted you to hear. And when you're in your 20s and you don't have any real wealth, that you really aren't paying much attention to what is really going on. But there was a lot going on during this period of time. Let me frame up a few things that might alarm you. The first thing is inflation. It was about 13.5% in 1980. Yes, 13.5%. That is huge. Right now, everyone's bitching because it's under 3%. It was over 10% higher during that period of time. And why we're going to get to later, what we're going to get to later, because I don't understand why high inflation was so destructive, but it is. The second thing were interest rates. And interest rates were at 19% in 1981. And why I remember this is because around that time, I had to buy a new car. Unfortunately, I couldn't afford it and I didn't have the credit. Too young, didn't have a cosigner, so it didn't work out for me. I wanted a new car, but I ended up with a piece of junk. Had to fix it up, learned a little mechanical ability as I started, so to speak. Now, I remember going in and trying to buy my first car. Again, I didn't have anybody, any parent or anything like that was going to help me out and co-sign. But almost 20% for interest in on a used car. That's, I was thinking new, and then maybe I was thinking, okay, I can't get approved for a new. How about a used one? That didn't work out either, because even if I did get approved, that dollar amount per month would have crushed me. Interest rate of almost 20%. It just wasn't feasible. Now, the third thing is the federal funds rate was about 22%. Now, just put that into perspective. Today, it's about 5%. And of course, unemployment was about 10% in 1982. So what's interesting about inflation is that it was 13.5% in 1980, and it was 3.2% in 1983. So how does that inflation go from 13.5% to 3.2% in 1983? One way, raise interest rates. And that's precisely what the Fed did. They raised interest rates, and this was what they called the Volcker effect, which was the Federal Reserve chairman at the time, obviously raising interest rates during that period of time, screwed everyone. Let me break down on how we first got here, and two, what happens next. So to understand what happened in 1980s was I was early 20s, late teens. I was growing up. I didn't even see any of this. And if you're out there and you were about the same age and things like that, did you see anything? Now you have to go back to the Vietnam War. And of course, when Nixon took the dollar off the gold standard, both of those things had dramatic effect on the economy. The first one, of course, was Vietnam War. In today's dollars, it was over $1 trillion to fund that war. So where did that money come from? It came from printing dollars. You understand? So the higher the amount of money that they're printing, the higher the interest rate. Around that same period, President Nixon took the US dollar off the gold standard. What that did was that created what we call a fiat currency. It gave the government the ability to print money. And this was a result of the money, of all that money and all the expense that surrounded the Vietnam War. So why is this important? Because it's not that much different than the STEMI money that got injected during the pandemic and created the inflation that we just had a few years ago. And hopefully you're starting to see a pattern here. So what happens with all of the excess money in the economy? And of course, the dollar decoupling from gold, it was set at $35 an ounce back in the early 70s. And for you gold people out there, that $35 an ounce in 1971, today it's over $5,000 an ounce. So the first crash was really important to me because it was a crash on the Main Street and a crash on Wall Street all at the same time when interest rates go up so high to tackle the high inflation from the 1980s, early 80s. I'll tell you exactly what happens. Depositors that have money in banks also want a higher deposit because they're losing money from inflation. So as inflation has its run on at 13.5%, depositors start saying, I need more money. So the banks had to respond and they started paying depositors 12 to 15% on their money. Now, in contrast, as you guys know, it's where nowhere close to that. No, not 13.5. No, it's 1 or 2% today. But this is the real issue that happens. when banks started paying depositors 12 to 15% on deposits, they also had a loan at 6 to 8% out. And what's supposed to happen with a bank is they're supposed to use deposited money and lend it out at a higher rate to people that are borrowing. This is precisely what perpetrated the over 1,000 saving loans banks to collapse during its next 10 years. Almost, I think it was about 1990. So this period of time lasted 10 years. And I think that's really important because what was happening, just like today, people couldn't refinance. As rates go up and then they reset, there's no way that they can refinance because there were 5, 6, 7% because rates were so much higher in the 80s as loans matured. There's no way that they could refinance, and they started to default. And so because of inflation from the 1970s and the printing that happened after we broke the Bretton Woods agreement, which was decoupling the US dollar from gold, the Fed had to react by jacking rates as high as almost 20%, which crushed all the banks and crushed all the consumers. You're not lending any money, no more new mortgages. It was just a really bad time for a lot of people, especially if you knew a lot of people that were very, very strict with their money. So it's because they crushed both Main Street and Wall Street at the same time because of the printing of the money that happened in the 1970s and the decoupling of the US dollar. The US dollar became a free floating currency, which now call a fiat currency. And of course, they're printing money today like it's water, no big deal. Sometimes when things happen, you have to dig back to why. You have to think back to why. And in this particular case, we had a roundup of on inflation, just like we did injection of the STEMI money. And of course, what the Fed do? Well, they raise rates to offset inflation. So this is straight out of the playbook. So this is the first real lesson I had about economics that I never, ever got while I was in the early ages, 20, 25. So luckily, all this ended up around, say, 1991, and I was still probably my early 20s at that time. I had no investment yet of any kind, no real estate, but I did go through a pretty rough period, just like I'm sure many of you. And during this period of time, there was not a lot of jobs, and there was high inflation, and all those kinds of things were going on. And if you did find a job, there wasn't very high pay. But when you first start out, you just don't see it because it doesn't affect you at all. But as I look back on that time, who won during this period of time? People with fixed rate, non-renters, people that owned real estate, because inflation just pushed whatever hard asset you had at the time to another level. So during this period of time, I had no dry powder. I had no cash. I had no network. I had not invested in real estate, and I did not take any advantage of any of the things that I probably should have. Anything that happened that was left, well, I should have paid attention. Now, even when the government created what was called the RTC, the Resolution Trust Corporation, which was basically liquidating the assets from all those failed banks and people that were in position to buy those assets. This was the biggest financial opportunity of their lifetimes. I, of course, not learning any of this, just managed those properties for all those people that made all that money. So the lesson for that period, of course, is being hard asset, and the government will print, and there will be more cycles due to high inflation and high interest rates as the Fed continues to combat these kinds of things. And now a word to think about: save your money. And I'm just going to say it: put your money in silver, put your money in gold, maybe even crypto. That's a little thing that you got to do a lot of research on, but crypto is another one that could make you some decent money, but you got to be savvy when it comes to crypto. Silver and gold, it's been up and down. For the last year or so, it's mostly up. And if you're someone who owns gold or has silver or has thought about buying into silver and gold, most people think gold just sits there. Well, you buy it and you pay wherever you buy it from. You could buy it from a bullion dealer, maybe a coin shop, maybe a pawn shop. Now, and then you hope that the price goes up someday. But monetary metals do something a little different. They build a system where gold can potentially earn a yield, not through speculation or through trading, but leasing gold to businesses that genuinely need it for productive use. So just to be clear, this isn't about predicting gold prices or chasing returns. Now, the same thing goes for silver. I'm more of a silver buyer than I am a gold buyer. Gold has been extremely expensive compared to silver. And I think silver has a much better upside to it in the years to come. Now, it's about the understanding of how gold can function as money. Again, if you're hearing this and thinking, I don't fully understand how gold leasing works, that's normal. Most people don't. That's why you should consider booking a call with a monetary metals team. This content is sponsored by nobody. I'm a nobody on YouTube, but I've done some research and I have been a stacker for multiple years. Not a huge amount. Don't get me wrong. I'm not like Fort Knox for my area, nothing like that. But monetary metals offerings involve risks. But it seems like that risk, in my opinion, is minimal because over several years now, I've seen way more upside than there is downside. It does pull back. It is a volatile metal. Same thing with silver. But it has gone up way more than I have seen it go down. Past performance is not indicative of future results, and see my disclaimer in the description below. Now, viewers should consult directly with a monetary metals advisor and their own financial legal team and tax advisors before making any investment decisions. But, in my opinion, it is one of the best things I've ever done. If you want to learn more, you can go to monetary-metals.com and you can get some more detailed information without even spending a dime. But again, you might want to seek professional help in your area, and you can actually talk to someone face to face. Now, this is what we definitely should be concerned about. The United States financial economy. It doesn't look good. It doesn't look good for multiple years. You might be thinking, well, the Dow's at record highs. At least it was until it started crashing because of the war going on. But First crash was a physical asset crash that affected Main Street and Wall Street. This was a dot crash that affected paper. Those people at the top in the stock market and speculative investing and tech, all of that, to be fair, I did lose a little bit of money, but it always came back. Now, it was all very elusive. It was very speculative, but I can tell you that one thing is it wasn't profitable, and it was all based on it going up. And over time, it has come back. It seems to always come back. I mean, look at the crash when it went during the crypto era. Or, my apologies, when the pandemic hit. Just as soon as that happened, within 6 months, it started recouping, and then it not only recouped, it also went much higher. So while the first crash in my 20s, this crash was my 30s, then it was just starting to make a little bit of money. I just had tipped my toe into the stock market during this period of time. Usually, it was mainly from a 401k. I didn't have a financial advisor. I would listen to people. So doing that without getting a financial advisor involved probably was my downfall. So I do recommend a financial advisor. But I jumped in very hardcore, thinking I knew what I was doing. I read a bunch of books. 401ks hit. Probably I was in my mid-20s when I was first had an opportunity to get into something, and started doing well. Nothing crazy, like 4 to 6% per quarter. It wasn't nothing crazy. I started putting more and more money into it. The NASDAQ peaked on somewhere around early 2000s. You had a 400% rise in 5 years, and then it popped on March 10th, 2001. I think it was 2000. And during that period of time, it tipped 40%. And why I am explaining this is because this was my first lesson about paper assets. And guess what? That did not get hurt. Banks or real estate. So at this point, you can imagine as a 30-year-old kid, I'm scratching my head and saying, what happened? I had physical asset crash that affected Wall Street and Main Street. My 30s, I had the paper asset crash that was entirely something different, didn't affect banks, and didn't affect real estate at all. So what was different? What were the signs that I missed? And what were the signs that were the same? The banks were fine. Housing was fine. The interest rates were about 6.5%. Inflation was on 2 to 3%. The unemployment was sitting at about 4 to 5%. So it doesn't seem that bad. So what happened when we had almost $10 trillion of loss in a very short period of time? Because you can imagine this period of time destroyed a lot of wealth. And what was happening here is baby boomers were saying, holy cow, I'm going to now have to work for another 10 years because a lot of people were set, but poof, all of it is gone. But if you remember, if you don't pull out, usually if the bank or the whatever you're invested in doesn't tank, it does come back. This has happened for multiple times for me. This was all funded by speculative growth, and they didn't pay attention to the profit, just like what happened in real estate. And of course, earnings. Forget about it. Completely irrelevant. So this is very similar to what's happening now with AI in the beginning. And this was very similar to what happened with all of the crypto and Bitcoin and all of that in the beginning. People piled on and drove to price it up, not because it's a great investment, but because they were piling on and it was speculative, and it drove the price up as a result of the interest in that particular product, as opposed to the fundamentals that we teach, that I've been taught. So what was interesting? This was in just 3 years. This was a paper asset crash, and a lot of people lost a lot of money. So you really got to understand what you'll see in the government was afraid of what they were afraid of deflation. So what happens when the government is afraid of deflation? They do one thing. This right out of the playbook again. So the rates go from 6%, 6.5% to 1% in just 3 years. What that does is it starts the new speculation and appreciation for what would be the next bubble, which is the GFC, which is crash number 3. The interesting thing is that the Federal Reserve was concerned about deflation. So they took the rates from 6%, 6.5% down to 1% in just 3 years, which of course made people start borrowing again. And just like a fire on a fuse and of a stick of dynamite that eventually blew up and was called the GFC. But the dot crash was the result of them lowering the Federal Reserve from 6.5% to 1%, which eventually created the very next crash, which we now call the GFC, which was the third one, and that, of course, I was ready for. So having learned what I learned in the 1980s, and having learned in my 30s and then into my 40s, I am now in a great position of learning from the third crash, which is when I made most of my money. Well, I didn't make a lot, but I could have. I just I held my money. So, but in 401ks and some of the state funds, I did pretty well. So to really study the GFC, you got to go back to the 2003 timeframe when the Federal Reserve lowered interest rates to basically zero. So during this time of period, of course, people borrowed. That's exactly what Trump is trying to do right now. Rates are at 5, 6, 7%, and he's trying to push it down. So be careful here, but also take advantage of the opportunities, because of the cost of the borrowing goes down to zero. Well, maybe 2, 3%, something like that. It's going to unlock all this trapped equity that's sitting in people's homes today. In 2003, when the rates went down, people started buying and price started to go up as they would. Now, it's also important to understand that that both Clinton and Bush had policies during this time that they were promoting everyone needs to own a home. American dream is the thing. And you go back and you look at they had different kinds of policies, but they were basically the same kind of policy. Essentially, they wanted everybody to be able to afford a home. Does that sound familiar? That's exactly what's going on right now. So what's really, really interesting in home ownership rate went up. If the home ownership rate went up to 69% during the period of time, currently it's sitting at about 65% now. While that might not seem like a lot, but you're basically taking millions of people that would be normally renting or moving them into the home ownership side of the equation. If you're a landlord and you own apartments or you're managing them, that was a rough period of time because you could fog a mirror and buy a house. And that's what exactly is happening. A lot of people fogged the mirror, bought a house, couldn't afford it later. It went all the way up to 69.1% and then popped. What happened at that point? All these people, when they said, hey, I know you're renting, but now you're going to buy a house. But guess what? You got to pay for it. They couldn't pay for it. So it popped. That's all. That's, of course, what the movie The Big Short is all about. I highly recommend you watch that because there's a lot of people that watch all of this just like I'm teaching you today. Now, these are patterns, and you can watch what these things because they're not actually moving that fast. When home ownership got to 89.1% and that popped under Obama, what happened was 3, 4, 5 million people were being foreclosed on. And of course, all of those homes moved over into the MSL or the multi listing service, and people lost their homes like crazy. So you can imagine we went all the way to 69% and then all the way back to 63% home ownership. So that 6% represented somewhere between 8 and 9 million people. So I just want to put that in perspective. 8 or 9 million people in a fairly short period of time moved from single family homes into rentals. Now, this is precisely what fixed the multifamily market and made all those folks think that they're so smart. But really, what happened was all these people moved from home ownership to the rental side of the equation. And because there was only a limited stock of multifamily families at the time, and the occupancies went up, so did the values, etc. But before we go there, let's jump back to the GFC. Now we've got the GFC. There's 4 million homes in the MLS. What happens? Home values are going to like this in a bubble market. You might have had 40 to 50% decline in value. So things went from, let's say, 300 to 150. But in most markets, it was about 25% adjustment. But the whole nation adjusted. Everything went to here and it went down. And why? It's because there were houses on MLS at that time. And of course, a buyer, you had lots of options. So what do? You go borrow at really cheap rates. You buy these houses that just got crushed financially and have been repriced, and you're taking incredible deals. And so when houses were crashing, people were moving over to the rental market. That's precisely when when people buy multifamily homes, maybe apartment buildings, might be something that you might want to consider because that is where everybody's going to go when the housing market crashes. And if you don't think it's happening now, you should look at some of the markets around, especially for Florida, I think parts of Texas, South Carolina. I've looked into multiple areas and the prices are extremely cheap, in my opinion. And are they going to get really cheap? Yes. I'm going to say if they don't cut in half, I'd be surprised. And again, I'm not a financial guru, but you might want to talk to people. Talk to real estate agents that do multi-market areas, that they might be in your area. But also, if you're looking to move or you're about ready to retire, look in other areas that you're interested in buying, whether it be a rental property or a vacation property, and you have a management company that leases it out. You wouldn't believe what's going on. You can get a 1 bedroom, 1 bath condo on the ocean in South Myrtle Beach for as low as $50,000. It's going to need a little work, but a condo on the beach, you got pools, you got the ocean for $50,000. It is extremely cheap. This is what I'm talking about. Now, official peak was about 2006. Official, though, there was about 2016. There was about a 10-year period of where home prices started to come down, and then until then, well, they got back to where they're originally. That was about 10 years. So what was going on during this period of time? Inflation was sitting about 1 to 4%. Not so bad, even though the Federal Reserve had a 2% target. Unemployment peaked at about 10% in 2009. So it got worse, of course, when it first started to pop, but it was sitting around 4.5%. And it got up to about 10% in 2009. And from there, it started to chip away and go back down again. So when the federal funds rate again went to zero in 2008, that's just a signal to load up. Now you got interest rates at almost zero. You got a huge correction on the real estate market. So this is by far was an incredible opportunity that everybody had. And you could have made a lot of money, jumped on some of these if you had the money to do it. But I know I didn't. So it's very difficult for you guys to watch a video like this and actually absorb it without doing a little bit of research, and maybe come back and watch this again. Do a little research, come back and watch it again. And also leave a comment. Now you have to live it. That's why I say go research it. See what parts of the country have a huge reduction in the price of these condos and homes. And look what's going on in the rental areas. If you need an apartment, apartments are ridiculously priced. And it's because, again, people need these apartments to live because they're getting foreclosed on. This isn't nothing made up. You might even have someone in your friends list that's a broker, a mortgage broker, or a that sells property, and see what's going on. I don't think there's a lot of properties popping off in most of the areas of the country. I've watched these cycles. I've watched the playbook from the Fed, from the administration, on exactly what they want to do for affordable housing or home ownership for the first time. It's already been done. And each time there's a new policy or interest rate adjustment, there's a ripple effect. And then, of course, there's the lag. And so once you start to see the signs, it starts to be crystal clear. So if you're doing this for yourself, open your eyes and pay attention to what is going on right now. And you're going to see every 3-4 months, it's going to change. Keep an eye out what's going on. See what's going on. Look in the past. See what happened only 2 years ago, 2.5 years ago, somewhere around there. My area, I don't know about all of the country, but you had homes that might be advertised for $300,000, but you had a bidding war. They were also stating that during this bidding war, you might have to pay 20-30% above and beyond the asking price. Along with that, most people were saying, well, I'll do this, I'll give you this much money above and beyond the asking price, but I'll waive the home inspection. That is just nuts, is my opinion. If I didn't get the house, I move on to the next. Or I just wouldn't get one. But people are just going crazy. Now it's a different story, only a couple years later. Now, of course, they're talking about the Fed and where they want the Fed rates to be. And the interesting thing, it is going to create a window, just like we've had before in the buying opportunity at discounted rates, which is exactly what people are going to be doing, especially if you're watching this and you're preparing. Now we're taking advantage of, at least I'm thinking I'm going to be taking advantage of something in the Myrtle Beach area. When you have right now, before this all hits and crashes totally, you have a piece of property, this condo, nice area, South Myrtle Beach, on the ocean, a 1-2 bedroom, 1-2 bath, halfway decent kitchen. I mean, more or less a nice little getaway, right? The balcony facing the ocean, and a 1-2 bedroom is between $50,000 and $100,000. It's going to drop. It is going to drop. It has to. If it's like that right now and nobody even knows about it, what's going to happen when people are losing, they're going to foreclosure? It's going to drop. Or it's going to go to the bank, and then the bank is going to dump it. They don't want to be real estate. They don't want to be more, they want to sell you a mortgage. They don't want to be holding real estate. Now, so you don't have to act quickly. You can take a look at markets. You can take a look at what the rentals are doing as well. Get a perspective of the area that you're considering. You can take a look at debt. You can see how things are being run. You can actually see the math. What was somebody's loan? What's the value? What was it? And who's taking the cut? Who's going to be losing? Is it the person that borrows? Is it the bank? Is it both? Again, it's just a playbook that we've seen before. So financial crisis 1 and 2, which was entirely different, but had massive lessons for everybody that have been paying attention. And for my third financial crisis, which was the GFC, I apologize. Here's the most interesting thing that happened. Banks are not lending and investors are not investing. So this is when multiple people are going to jump on. I mean, you can consider another country if you wanted. If you're interested in a piece of property, look at what's out there. Look at your opportunities, especially in the United States. Are there going to be banks collapsing with this next financial crisis? Are there going to be people like you and I having to go into foreclosure, look for a rental property, an apartment? It's not going to be good. So rental properties and apartments are going to go up sky high. And they're going to be dumping the banks are going to be dumping these homes. Be prepared. Now, if you've been looking at the U.S. from the outside perspective, you would have thought it was a bargain too. And guess what? That precisely is what's happening. We started to see massive foreign investments. But my friends, that was part of the recovery process, was a lot of outside investment into the United States. No matter how you like the US from an outsider's perspective, it is still one of the most stable countries on the planet. So here's the lesson. Investing in 10% math and 90% psychology. And of course, it helps if you're investing with somebody who's been through the cycle and is watching it from a different perspective than what you are. All these little levers that all these little politicians are using to manipulate whatever it is that they're trying to manipulate. There's so many stories of wins during this period of time. And like, for example, in 2010, some people bought multiple unit homes or apartments or apartment buildings, apartment complexes, lender owned, 50% vacant. And that deal that could have been made, it was probably 50% off. But being 50% vacant, you don't have the income, you might be aware of what your opportunities are, but also what is going to be going out the door until you get the vacancies filled. But you might know, based on what was going on and what is going on right now, homeowners are moving in as their foreclosures are stacking up at the banks. Now, if you are looking for a piece of property, I wouldn't do it right now. I think because we're not being told anything, it is, I don't know how people aren't aware of this, because for the last few years, interest rates going up, multiple areas are starving for buyers, but there's a lot of homes that are up for sale. There's other areas, of course, that are always buying and selling. There's always something going on. And they're probably selling more than what the people are trying to push. So there might be not much of a surplus of homes out there for sale. But that's not most of the places. Again, look into what I'm talking about. Talk to your local realtor. Talk to realtors in other towns that you might be considering, if that's what you're planning, or if you're planning on not buying a vacation home and then using a managing company to lease it out for you, or rent it out, or for people going on vacations, especially around Orlando or any part of Florida on the east or west coast, especially Miami and those areas. But see what's going on and prepare for it. Because you could, in the near future, probably within, it seems like it's going to happen in less than a year. But if Trump gets in, a new Fed chair, and that Fed chair does drop the interest rate prices or dollar percentages, it is highly possible that the financial economy could go either way. But be prepared. Thank you for stopping in. I do appreciate it. Try to have a great rest of your day. And God bless.